Hey everybody, welcome back. Today's topic is how to select a stock when choosing wheel strategy for trading. The example stock will be Hims and Her as it was requested by one of the community members. Selecting a stock for wheel strategy is slightly different from selecting a stock from selling any other option strategy, for example, spreads, iron condors, butterfly, etc. So in this video, I will walk you through my guiding principles for selecting a stock using the examples of Hims and Her. And hopefully by the end of this video, you will have a decent idea whether you want to use Hims or Her as the stock for running wheel strategy or not. So if you end up enjoying today's video, make sure you give us a like so that the video can be pushed out to more people. And without further ado, let's dive in. Before I talk about the principles for wheel strategy and take the example of Hims and Her, let's understand what wheel strategy is. A wheel strategy has two components, selling puts and selling calls. You will sell a put to acquire the stock, and then you will sell call to let go of that stock. And that you can see right here in this diagram. You sell a put option. If you get assigned, you will sell a covered call, and if that gets assigned, you sell a put. And this is the reason why it is called a wheel strategy. So the website that I'm using to show you this diagram is called Options Alpha. I'll put the link in the description. You can definitely check it out and read more about the wheel strategy if you are not very familiar with it. Okay, so now you know what a wheel strategy is. And the first principle or the first rule, which is the cardinal rule, is do you know the stock? You can use different websites. For example, I'm using Seeking Alpha. You can use MarketWatch. You can use finance.yahoo to understand what the company does. As a starter point to understand what a company does, you need to know what the company is selling. Is it selling products? Is it selling services? Once you know that, you need to kind of understand what is the market cap of the company, how much company is bringing in the business, how are the earnings of the company, at their earnings history. Then I would recommend looking at their earnings estimate. I would also recommend the balance sheet, how much debt the company has, how much assets the company has. Look at the income statement, what revenue they are bringing in. These are very important things. So this is the earnings report of Hims and Her, the investor presentation. Always go to the investor relations, get the latest earnings presentation. You need to know who these players are, who is the management. So that is the first and foremost cardinal rule. Know the company before you use it as a wheel strategy. The second principle is how long do you want to own the stock in your portfolio? And the reason is a lot of times you may get into a position where when you sell the put, the stock gets assigned to you and you may not be able to sell a covered call because the value at which you bought the stock has fallen below your strike price. So let's take an example. Let's say you bought Hims and Her at $14 today. In 2 weeks time frame, the stock gets assigned to you, but then the stock falls 30% below its market price and the current stock price is $10. You would not be able to sell a covered call. So you will be stuck with the stock for an amount of time until the stock starts to see an uptrend where the option prices are high, and then you will be able to sell a covered call. So understanding your time horizon for the wheel strategy is the second principle that you need to know before you use any stock for selling wheel strategy. The third principle that you need to keep in mind is the liquidity on the stock. Liquidity basically means is how much volume is being traded on that stock. And it is very important that when you're using wheel strategy, you need to have high liquidity in the stock. So in our example for Hims and Her, let's see how much liquidity do we have. So this is a website called barchart.com. I use it for the put and call ratio, but it also gives you a volume graph. So you can see that the stocks, whether it's on the put side or on the call sides, have a very good volume, and this volume shelf is very important when it comes to liquidity. Let me give you an example of, let's say, Discover Financials. You can see that even though they have some put and to call into few thousand, they also have open interest at levels at 76 and 54, 85 and 29, 6 and 33. When you are selling options for these dates, you don't have enough open interest on either side of the shop. So this is not the ideal stock that I would want to sell options on. Whereas on Hims and Hers, you are seeing a very good volume shelf. So this will help you move the stock from one stage to another. The fourth principle is the bid and ask spread. Whenever you're looking to sell options on or buy options on, you need to have a very tight bid and ask spread. What do I mean by that? Let's take a look at the bid ask spread for Hims. This is the options change for Hims and Her, and for a 24th May expiration, which is 6 days from the time of this recording, our bid ask spread is 35 and 40, so which is a $5 bid and ask spread. Ideally, you would want a $1 or $2 bid and ask spread. So a similar stock like Palantir, which is around the $21 trading level, the bid and ask spread is 30 30 and 32. So this is a $2 bid and ask spread. If we take a look at a stock like SoFi, you would see the bid and ask spread is $1. So the tighter the bid ask spread is, the better it is when your options contract is being executed. So lesser volume and higher bid and ask spread are generally go hand in hand. So try to see there should be high volume, high liquidity on the stock and tighter bid and ask spread. It will help your contracts execute faster. The fifth principle is understanding the stock trend. Whenever you see a massive upswing or a downtrend in a stock, that is not the time that you would want to sell options on or even run a wheel strategy. The ideal state is the stock should be trading in a range, and that is going to be an ideal position where you can get into a stock and get out of the stock and keep rinse and repeating while collecting premiums. Because the primary objective of wheel strategy is to generate income. So to understand the stock trend, you will have to use some kind of a technical indicator. One of the easiest way that you can understand the trend of the stock is by using a technical indicator called Bollinger Band. So in the case of Hims and Her, you can see the middle line, which is a blue line, is the mid range. So around 1531 is the mid range. The upper range is 1689 and the lower range is 1380. The stock is at 1457, which means that it is at its top end of the range. Now, I particularly don't use Bollinger Band as part of my analysis. The one that I particularly like to use is Fibonacci retracement, and then we will on top add something called volume profile. Fibonacci retracement will help me give the levels, and then the volume profile helps me understand where the biggest volume shelf is when we are looking to sell options on, whether from a covered call standpoint or from selling put standpoint. Few days the stock has really started to head up. Now, where is the stock that we feel like may have a resistance on is somewhere around the level of 1527. This is where the volume shelf goes a little bit below than the levels below. So you could sell a put at maybe $14, which will be around this level. You have a very good support level here. We have a lot of touch points, 1, 2, 3, 4, 5, 6, 7, 8, 9 touch points here. And then we did have a clean breakout over here in the last trading day. So you could look at selling an options at 14.10, or you could look at selling options at 13, depending upon the premium and depending upon the length. We'll get to that a little bit later, but you could use a technical indicator like this to understand where is the stock heading. The sixth principle is avoid stocks that have high short interest. Now, this ties up with my previous point that you want to sell wheel strategy on stocks that are in a range bound. When there are stocks that have high short interest, those are liable for short squeeze, and you don't want to be in a position where you got a stock at a very good price, and then because you're running wheel strategy, you will be capping your upside potential. And in scenarios like that where you get a short squeeze, you may end up feeling not too good about yourself. Let's say Hims and Hers has a very high short interest. Let's say you get into Hims and Hers, you buy the stock at $14 and you try to get out of the stock at $15, making $1 profit in that trade while collecting premium. Now, let's say because of the high short interest, you get a squeeze and the Hims runs from $15, $14 to $25. So basically you ended up capping almost $9 of upside potential. So that's the reason you want to avoid stocks with high short interest, because you could see a massive upswing or a big downtrend, and that is not going to be very good in the experience of selling wheel strategy. Principle number 7 is capital investment. Remember, when you are trading wheel strategy, you need to have high capital because you are going to be using a cash secured put. If you are buying Hims for $14 and you are buying one contract, which is 100 shares, you need to have $1,400 in your account as a cash secured put. I highly recommend not counting margin or utilizing margin in this scenario if you are in the beginning stages. The reason is because when you get a margin call for whatever reason and you do not have sufficient fund in your account, they are going to liquidate your other assets to cover that margin. Try avoiding selling cash secured puts if you do not have capital, and wheel strategy is very capital intensive. Eighth and the last principle is trading versus investing mindset. The primary objective of running a wheel strategy is to keep trading, which means that you're getting into a stock, you're getting out of the stock, you're getting into the stock, you're getting out of stock in a constant fashion while generating premiums. So income generation is the primary goal, not capital appreciation. So keep that in mind. There you go. Those are my 8 principles when selecting a stock for trading wheel strategy. For our community community member that asked whether HIMS is a good one or not. Hopefully you got that answer whether HIMS is a good one or not. Let me know in the comments if you have other strategies that you use while running wheel strategy. I would love to know more. And if you enjoyed today's video, make sure you give us a like, click on subscribe and ring the bell notification. I will see you next time, investor family, but don't forget to invest for tomorrow.